Jim, the Fed has held rates near zero for the longest period in recent memory, and most folks expect the Fed funds to remain fixed for the next 6 to 12 months. If you add the dollar carry trade, it seems as though the stage is set for yet another explosive move in precious metals. What are your thoughts?
Well, I think it's actually happening while we're talking. And the reactions after the break above 1,000 are so well contained that it speaks again of sovereign interest. So the targets of 1224, 1278, and 1650, I think, are probably coming a much sooner than we otherwise would have considered. So I don't think that where we stand today, and say, well, gee, is there another rise coming? That the implication is that the present rise is stopping. But we haven't seen that yet.
Looking back over the last 9 years of this precious metals bull market, all four primary waves higher seem to occur in the fall and winter months.
I'm not sure that seasonal factors exist in the minds of traders and are, because of that, become rather self-creative. We're not in a market now where demand for the holiday Diwali in India or marriages is really going to be the criteria for price. The criteria for price now is its relationship to the U.S. dollar. Gold has really taken its position as a major international currency. I would rather look towards what you expect, or I expect, or we expect for the dollar in the winter as to what will happen to the price of gold, more so than any assumed effect from supply and demand of a commercial nature, which is the only way you get seasonality.
From a technical perspective, the yellow metal has moved sharply over the past month, and using the previous breakouts as a guide, it was common to see gold enter a trading range for maybe a few weeks or so before completing that primary move. Do you see a similar scenario unfolding with the second stage perhaps coming early next year?
I would suggest that if you take a look at since we're on technicals now, and if you took a look at Dan Norcini's work on the site or your own work, you'll see that we've been walking up in a staircase. In other words, if you'll picture what a staircase looks like and then look at the movement of gold, you'll see that it's almost perfect. Now the staircases are being shortened, and the psychology of that is that it's accumulation, markup, accumulation, markup, accumulation, markup that creates a stair. It's marked up now. The patience to accumulate seems to be getting much shorter. That means a shorter stair. So normally when that takes place above or at a new high, potential of an exponential rise needs to be given very serious consideration. So let's not call this move over until it is over. That's the way money is made in this. When gold moved over 400 for the second time back in the 70s, the huge money was made by the guys that took their positions and couldn't be taken out of their positions. For the same reason, I'm suggesting we should be very attentive now to that staircase and how short the stairs become. Because again, at a new high, we used to call it a Swiss staircase, and it was always inside information back in the 60s and 70s that the Swiss did, and they were very disciplined. So they accumulated and marked up. But that looks to me to be a discipline of a sovereign nature. I think the sovereignty in this has created the stair, and now the speculators and the investors and those scared to death of what's going on in monetary and now fiscal measures are not waiting as long in that stair to accumulate. So exponential is very possible.
In the last three big moves higher we've seen since 2001, it wasn't uncommon to see gold climb 40-50% from that breakout level, or at least from the lows. And if we use the $1,000 point as a guide, that could put gold in the $1,400, even $1,500 area if an exponential rise unfolds as you think could be happening.
Well, the math is right. You're 100% correct in what you've said, and it's kind of interesting to see that Merrill signed on to 1,500 today, which is an unusual thing. So, of course, it's quite possible, and I'd rather say that till I see evidence to the contrary, that is exactly what's in gear.
So given that scenario, it looks as though your $1 million wager on 1650 gold before January 2011 is looking very good here.
It is looking very good, and that's to the surprise of everyone, including me. You can have all the confidence in the world, but we live in markets, so there has to be every once in a while at 2 o'clock in the morning, oh my God, what have I done?
Plus we have some pretty strong folks on the other side of the equation.
We do, and if you fail to respect the other side, then obviously you're going to go wrong.
Would you mind telling folks a little bit more about that bet?
I'll be absolutely happy because nobody took it. People who wanted to take the bet wanted me to do it as an over-the-counter derivative. And who is the last person on the face of this earth that can enter into an over-the-counter derivative? You're talking to them. So it never got taken. You know, there were a lot of people that you have nothing to lose. They'd bet you anything in the world, okay? If you lose, you pay them, and if they lose, you can't find them. You know, it never got taken, although it was held out to be offered for about 6 months.
Well, no pound of flesh to extract then, I guess.
No, but it's still as if it's there because, you know, you wake up at 2 o'clock in the morning, you can't remember whether you did it or you didn't. And I used to trade day and night, as of course we all do now, but back in the 70s, and I had a broker over in Hong Kong called Alex Chan. Call up Alex, we make all kinds of trades. One morning I woke up and I said, I think I did something, but I don't remember what I did. So I had to call up Alex to find out, did I call you and did we make any? And believe it or not, we did. We made a trade and I fell back asleep and forgot about it.
Instead of sleepwalking, you're sleep trading.
Yeah, Alex, and back in those days I was so active that whenever Alex came in the markets on my behalf, they ordered all the old men off the Hong Kong and China Gold Association. You have to make trades there by touching the person you trade with. And when Alex would come on, he'd create such an uproar on that exchange that they were afraid the old men were going to be killed. Which we were going to Alex Chan. That was a wonderful time.
You know, given the high volatility of precious metals markets, Jim, it seems that holding bullion and related coins is one of the few sure methods to ensure participation in this fast-moving bull market. What percentage of a portfolio would you recommend for folks to hold in physical gold?
Well, you know, you used the key word there, to insure. You don't speculate. You don't trade for insurance. You know, that's an entirely different subject and shouldn't even be considered at these times in the market. The person who holds a physical is basically offsetting the balance. It's like having half dollars and half euros. You basically go nowhere. But then what you do is you maintain your buying power. So a person seeking to maintain their buying power now, who we will, let's say, talk to somewhere between 500 and 1,000, would have a much higher percentage of their net worth in the gold. The minimum is generally about a third. But understand that as the price rises, okay, then the percentage changes. And a person seeking insurance should remember that and not get into speculation. So, you know, you review your position every quarter. And a person seeking just to maintain their buying power would be 50-50.
You know, Jim, as gold does approach 1,600, you know, I bet that mainstream media, their talking heads will emerge with talk of a 1980s-style bubble and crash. Tell folks why this time around that might not occur.
Well, the main reason is changes that are taking place, such as the call for a super sovereign currency unit, diversification from the dollar, the unwillingness for other countries, especially in Asia, to allow the U.S. to make their monetary policy. And that's really what happens to you if you hold a reserve currency to a significant degree. You could look at the 70s as a rehearsal, but don't look at this as a rehearsal. This is for real. And the for real nature, in terms of the significant systemic shift in reserve basis around the world, would, I firmly believe, leave gold at a holding on to a much greater percentage, if not 80%, of the move to whatever its final high is. Then I suspect that there's a mechanism out there where it's not gold convertibility, but there is a mechanism of putting an alarm system back into the dollar, which would be the utilization of an old way, which was the Federal Reserve gold certificate ratio, and modernizing it and revitalizing it so that it ends up not being an automaticity connected to an interest rate, but rather an alarm system by the price of gold as connected to a broad measure of international liquidity. It wouldn't make anything happen, and probably the Treasury would never have to do anything because, as the marketplace we know now, there'll be all kinds of vehicles trading based on that relationship, meaning that it will change by itself without the Treasury having to do anything towards repair. That would then give the dollar an appearance of not being tied to gold, but having some degree of discipline. Added to that, Volcker's suggestion of a return to policies that have a historical precedent for being able to change deficits back to surpluses in the midst of a crisis could actually mark the low side of the dollar. I tend to think that what you're just going through is a systemic readjustment of international monetary procedures. And therefore, I'm going to tell you, 80% of the move will be held.